You now know what an option is. You know about strike prices and time. But there's one more force that drives the price of every contract you'll ever trade. It's called implied volatility. And once you understand it, you'll see the market completely differently. Here's what volatility actually does. It sets the price of options. Not the direction of the market, not whether the asset is good or bad, just the uncertainty of where the price could end up by the time that contract expires. The wider the range of possible outcomes, the harder it is to price risk, and the more a seller demands to take that risk on. Uncertainty is risk. Risk has a price. That price is baked into every single contract. Now back to the land. Same property, same $500,000, same 12-month contract structure. But something is circling in the local market. Word gets out that a university is considering the area for a major new campus. No plans, no permits, no confirmation of any kind, just chatter. But the market knows what a university campus does to land prices if it ever comes to life. The buyer walks up, ready to do the usual deal. The landowner stops them. Same $20,000? Not today. Nobody knows where this land ends up in 12 months. If that campus gets confirmed, this property could double. I have no idea what I'm selling you the right to. That uncertainty costs you. The contract is $60,000. Nothing about the land changed. Same property, same strike price, same expiry. The only thing that changed was how uncertain the outcome had become, and that uncertainty drove the option price up. That is implied volatility. Now the plot thickens. The university rumor runs hot for months. Option prices stay elevated. Then the news breaks. Strict planning regulations mean the campus cannot proceed anytime soon. And just like that, the market fractures. The optimists say it's still coming eventually and hold their ground. The fearful say it's dead and start selling. Buyers and sellers clash, prices swing. Nobody agrees on where this land is headed. And that disagreement, that push and pull between fear and optimism, is volatility in its rawest form. The landowner looks at the chaos and shakes their head. I have even less idea what this land is worth in 12 months now than I did before. You want a contract? It'll cost you more than ever. Option prices climb again. Not because the land got better or worse, because the range of possible outcomes just got wider. That is the engine behind implied volatility. It is the market's live reading of uncertainty at any moment in time. A constant tug of war between fear and greed, repricing every contract in real time as sentiment shifts. When the market is calm and direction feels clear, options get cheap. When the market fractures and nobody agrees, options get expensive. Learn to read it and you stop asking whether an option is cheap or expensive. You start knowing. Take it for a test drive on the Passive Nomad Simulator. It's the most user-friendly tool on the web for replaying market history. Choose your expirations and watch how premium decay and volatility spikes impact your position in real time. Free to use, cutting-edge tech, even includes 0 days to expiry simulations. This is where theory meets reality.